Welcome back. You're watching Business Morning on Channels Television. We're still hyping the conversation around investing in Nigeria. We started off talking about Ponzi schemes, which a lot of Nigerians look at as the most realistic thing to be doing at this time to save a little bit of money and earn a little extra more. But then from the conversations, you know that if you don't have proof of whatever that company is actually investing in, it is not something you should be going into. It's too good to be real. Best look for a company that has all the information with regards to investment options, or if you are really in doubt, why don't you just talk to the Securities and Exchange Commission and they'll be glad to clear it for you. But we're talking to Johnson Chukwu now, who is the Chief Executive Officer of Carry Assets Management, and taking a look at investment options, investment portfolios, if you like. Good morning to you, and thank you so much for coming on the program.
My pleasure. Good morning.
So we've had
Anbaraka de Sala.
Oh yes, thank you. Well, welcome to you, Anbaraka de Sala. So a lot of people are, talking about investing at this time. It's a very tight situation where you have macroeconomic challenges, you're dealing with oil prices, you're dealing with a recession, no money in your hand, no money in your pocket. And in spite of all of that, there's been so much talk about most of the environment seemingly to be done in such a favorable way for more foreign portfolio investors than local investors. So based on that, how would you rate local versus foreign portfolio investing in Nigeria?
Well, in the first place, there are basically about 2 or 3 groups of local portfolio investors in the country. You have the pension fund administrators, you have the insurance companies, and then you have the banks. Then, to some extent, you have the staff cooperative, which are not quite strong now. So you basically have, and the major portfolio investors in Nigeria are basically the PFAs, the pension fund administrators, and the banks. As it stands today, only the pension fund administrators have the wherewithal to continue to invest in the Nigerian securities market. The banks, a lot of them are actually going through some level of liquidity squeeze. So the banks' priority now is to maintain their liquidity instead of maximize their profit. And periods of economic crisis, what institutions like financial institutions do is to focus on liquidity management at the expense of profitability. So now, with a lot of banks are not aggressive on securities instruments. As per foreign portfolio investors, you did mention that the environment has been made more attractive for them, in the sense that yield today are quite high. I mean, you're talking of yields. Nigerian interbank through treasury bills yield of about 20%. But the other factors that foreign portfolio investors look at, it's not just the yield that they look at. They also look at the liquidity in the market, they look at the securities of the investment, they look at the FX regime, they look at the policy environment. And today, unfortunately for us, the policy environment and the liquidity situation in the country, FX liquidity situation, are not attractive, will not make it attractive for foreign portfolio investors to come in. Basically, previously we thought if you increase the yield and also ensure there's liquidity in the FX market, you're going to attract foreign portfolio investors. But we don't have liquidity in the FX market. We are seeing maximum trade, average trade in the Nigerian interbank forex market about $600 million. That is not strong enough to attract foreign portfolio investors. And then you also have a huge spread between the official market, which is the interbank market, about 310, and the parallel market about 424. That wide gap indicates that the interbank market does not yet mirror the true value of the naira. And portfolio investors are not going to come when you have a huge spread between the parallel market and official market, because they expect the local currency to adjust towards the parallel market.
So what do you think local portfolio investors are leveraging on right now, if you have such a wide spread at the market?
Well, for local portfolio investors, if you look at the structure of pension fund administrator investments, more than 80% today are in fixed income instruments. More than 70% of that are in federal government debt instruments, either in FGM bonds or federal government treasury bills. So you realize that there has been a continuous shift to what we call, they have underweighted their portfolios in equity and overweighted in fixed income instruments. In fact, what they are doing is that they are maxing to the limit of the investment guideline in fixed income instruments. Because one, Fixed income instruments, when you invest with the federal government on federal government instruments, you are investing in what they call risk-free instruments. 2, the yield on those instruments are so attractive. And even individual investors like you and I are beginning to buy treasury bills. Simple reason is it. Why would you keep your money with the bank who pays you 13%, 14%, or even, I'm hearing banks say they can match treasury bills. But the treasury bills are discounted instruments. If you get an 18% yield on a federal government 364-day treasury bills, the effective yield is close to 20%. And the banks are telling you are going to match it to 18%. But next question you even ask, when a bank takes your money at 18%, what are you going to do with it? For a bank to take money at 18%, make provision for cash reserve ratio of 30%, make provision for liquidity ratio, cash reserve ratio of 25%, okay, make provision for liquidity ratio at 30%. The bank needs to lend that money at a minimum of 34 to 38% to recover the 18%.
And that most likely will not happen.
And that will not happen because when you give money to anybody at 34, 35%, it is certain, it's almost certain that that customer will default. Because what kind of business would a person invest borrowing at 34% and still make a return to cover that interest cost and meet up his overhead expenses? So you realize that any bank who is going to throw so much rate at you, you have to sit back and ask yourself, what's the bank taking that money to? Obviously, the bank is trying to cover a funding gap. And that is why for knowledgeable investors, when a bank becomes too aggressive with offer of yield, and you ask yourself, are there instruments that the bank is going to get returns to cover that level of cost? Then if you can't see that in the market, you will rather err on the side of caution, and investors are moving their monies to fixed income, federal government debt instrument. But there's also a major concern for that, because if this continues, eventually the local banking system is going to suffer from liquidity crisis, because a lot of the liquidity is moving away from the banking vaults of the banks to the vaults of the central bank, and the banks still have obligation to meet their deposit liabilities. So, but remember, the banks cannot easily liquefy their risk assets. What I mean is that the bank cannot easily recall their risk assets. So if they can't recall their risk assets and deposits are moving away, they're going to get to a point where the banks, a lot of the banks will not be in a position to meet their liability obligations. And that's why I expect that the next MPC meeting, the Monetary Policy Committee needs to review the current direction of yield.
So we have, okay, well, MPR is at 14%, and we have CRR hovering around 25%, 30%. So what for you will be the best as we, of course, go forward to next week, 1920 MPC meeting?
Well, I think I will look at it from a larger economic perspective, which is injecting liquidity back to the system. Today, you need to combine two things to restore liquidity in the banking system and the financial system. You need to drop the cash reserve ratio from current 25% to possibly, and for me, I'm going to be very aggressive, to possibly around 15%. And you also need to reduce the monetary policy rate down from 14%, maybe to about 10, 11%.
What if they decide to raise rates instead?
It is not impossible. I mean, the last raise we saw from 12% to 14% was completely at variance with what most of us expected. So you can't rule out the possibility that in their own wisdom, they could still decide to raise rates. But one thing I want to re-emphasize is that current attempts to fight, to manage the exchange rate by raising rates does not seem to work. And why it will not work is simple. The current inflationary rate, the current bid for FX, is not driven by banking system liquidity. It is not because banks are giving out money that those who have borrowed those monies are using the money to bid for FX, or that we are seeing a lot of overheating of economic activities that is leading to increase in inflation rate. The inflation rate we have is because of structural deficiencies, like due to the exchange rate, the true pass-through effect of the exchange rate. And you are not going to fight it by continuing to suck up liquidity from the banking system. For me, the priority now should be, how do we restore growth? How do we inject liquidity into the system? The federal government, the fiscal end, does not have all the way without to inject liquidity into the system. So let's first restore liquidity in the banking system. Because if you look at how that countries came out of the economic crisis, one, they restored liquidity to the banking system. Two, they injected cash into the hands of citizens. Two, they went through public works to create employment.
But then we have to also remember that, as much as the fiscal and monetary authorities are trying to see how they can inject money back into it, we still have unscrupulous individuals who are taking advantage of the downturn to engage unsuspecting Nigerians, and they're defrauding them. So all of this that we've said, what practical ways will it, work out for the investing public?
Well, the investing public at periods of economic uncertainty, that's what they call flight to safety. So at such periods, you move your investment from risky instruments to less risky instruments. And that is why, because the first thing you have to safeguard yourself, because before you talk of the larger macroeconomic environment. So what is most advisable for investors is to go the way of federal government debt instruments. As long as Nigeria lives, as long as Nigeria continues as a nation, the federal government will not default on treasury bills issued by it, neither will it default on federal government bonds. Simple is that the reason why when you lend to a sovereign in a currency which it has a capacity to print, that it does not default, is that the government has a capacity to tax. The government can decide to increase the tax on you and I so that it can pay its debt. The government can also decide in worst case scenario to tweak with the inflation rate, not to mind about the inflation rate and print money, ways and means finance.
So at this time, do we need to print more money?
No, that is not the solution to our problem. The solution to our problem, if you look at a macroeconomic problem, is that one, we need to stabilize the foreign exchange rate. To do that, we need to assess offshore funding. Printing money will not address the issue of stabilizing the forex market. If you do not stabilize the forex market, you're not going to attract foreign portfolio investors, you're not going to attract foreign direct investors. They need to come to an environment where you can take a position today and expect that the exchange rate will remain relatively within a certain band in the next 1 year. If you come into an environment where there's instability in FX, and let's assume you bring your money today at 350, for instance, and you make a return of 20%, and when you want to take out your money in 1 year time, the rate has moved from 350 to 500. That 35% increase or devaluation in the exchange rate is more than your 20% return on investment. So once you have instability in the exchange rate, foreign portfolio investors are going to stay away from the economy.
So just as we wrap up this conversation, from an asset management point of view, August inflation is around the corner, and interest rates, of course, that's the MPC meeting. What are you expecting?
Well, my expectation is that today the priority should be on how to restore economic growth. And if that's a priority, I expect that the Monetary Policy Committee will revise the increase in monetary policy rates, at least at the minimum back to 12%, but possibly down to 10%, and also cut down on the cash reserve ratio from current 25% to maybe 15%. We need to restore the wind in the economy. The inflation pressure we are seeing today is not driven by liquidity in the banking system, so we can't be fighting it by sucking up liquidity from the system. We need to restore the health of the banks, and we need to allow them resume their intermediation roles for the economy to recover.
What are your predictions for inflation rate? Of course, most are saying 17.4, others are saying 17.7.
Yes, I think we should see something like 17.3 to 17.6. My take is that the pass-through effect of the continuous devaluation in the exchange rate at the parallel market will reflect in inflation rate. Remember that the shop price that you see is based on the parallel market and not necessarily on the interbank rate, because a few people can access funding from the interbank market.
Okay, thank you so much for joining me on the program this morning, and Johnson Chukwu, and of course sharing your perspectives with us as we continue to focus on the economy.
My pleasure.
Johnson Chukwu is the Chief Executive Officer, Cowry Assets Management. Join me on the program to talk about investing in Nigeria, taking a look, of course, at local and foreign portfolio investing, and also giving us his projection for expected August inflation numbers, which we're expecting before the end of this week. Most are predicting between 17.4 and 17.7%. He's also staying on that side, 17.3 to 17.6. A lot on the plate of the Monetary Policy Committee when they meet on Monday and Tuesday. The very crucial MPC meeting that has everybody's eye on it. We've got our eye on the capital market in just a bit. I'll be talking to an equities trader who is the CEO of Enterprise Stockbrokers, Rotimi Fak.